Hi, this is Nick here, and I'm about to go through the updated business cycle report. So looking at the LEI index, so the LEI index is making new all-time highs for the cycle, and then here we're showing the year-over-year rate of change of that index, which is up 7% compared to this time last year. That's basically the most accelerated pace of advance that we've seen this entire cycle, with the exception of this beginning period here in 2010, which had these extreme base effects because of the recession. So this is basically the best acceleration in terms of the LEI index that we've seen. So that's a very strong indicator for the business cycle continuing. Then the yield curve, this is the 10-year minus the 3-year yield. That's still at 23 basis points steep, so it's still a ways away from inverting, although it is continuing to be on a general flattening trend, which may happen early next year. Then the U.S. PMI, so we just got updates on the manufacturing and the services, so both ticked a little bit lower, but both are at pretty elevated levels still. Anything above 50 is expansionary, so the manufacturing PMI in black at 57.7 is still at a strong level, which is also supportive of the ongoing expansion. Then turning to the global manufacturing PMIs, more of a mixed picture here. You can see Italy actually falling below 50 for the first time. Russia going from below 50 to above 50 now. So that's a positive, whereas Italy is a negative. But we do see this kind of choppy sideways readings here generally. But for the most part, still above 50, and all the big ones still above 50. So that's encouraging generally. Then U.S. unemployment momentum, so we just got the updated jobs report, remains stable at 3.7%, still well below its 12-month moving average, which is the gray line here at 4%. And the participation rate ticked up, which is also another strong indicator for the cycle. Then the San Francisco Fed leading unemployment rate model, that continues to generally be positive, with this gray model line continuing to generally trend lower. So that continues to be a positive. Then the U.S. labor market capacity utilization. So this compares basically the U3 unemployment rate to the CBO's estimate of what the natural rate of unemployment is. So this is suggesting that right now the U.S. economy is expanding above potential, which is basically, if this estimate of the natural rate of unemployment is correct, that represents an unsustainable state of the economy, but these estimates are very subjective and subject to error. Similarly with the U.S. Gdp Output Gap, so this compares the actual GDP to the Congressional Budget Office, or CBO, projection for potential GDP. Right now we're operating above potential GDP, so that similarly suggests operating above capacity, which is which wouldn't be sustainable, and so both of those are suggestions that we might be in the late part of the cycle here. Then the Atlanta Fed GDP forecast in gray, that's at 3%. We did get the Q3 reading, the first reading, at 3.5%. The U.S. household credit cycle, no update this month, so that the last data point was positive for the end of Q2. The Q3 data point will come out later this month, later in November. Then U.S. consumer confidence continues to trend higher here on the Conference Board reading, but is somewhat chopping sideways on the University of Michigan reading. So a little bit of a mixed picture here. Generally, I'd say these readings are still trending higher, which is a near-term positive, but at extreme levels, this can act as a contrarian indicator, so something to be mindful of with respect to both of these, but particularly the Conference Board reading in black there. Then lending standards, bank lending standards continue to ease. This is a quarterly number as well, so no update from last month's report, but just showing that, yes, in fact, banks are easing lending standards, so that is supportive of the economy as well, and to some extent undoing some of the tightening work that the Fed is trying to do with raising rates. High yield spreads, so we did have a little bit of a risk-off period in the markets. between this report and last month's report, and so we saw the high yield spreads tick higher here. They were briefly above their range. The multi-year range here has been from 290 to 375, and this did tick up to 379 briefly, but we are back within that range under 375. Then this is a new chart that I'll continue to show going forward. This is U.S. building permits in gray with the 12-month moving average in black, and you can see that this does historically act as a long leading indicator. It tends to be trending down going into prior recessions, and so we're seeing here that this is possibly looking like it might be kind of a topping process here. I would want to see a few more months of data to confirm that trend. So my characterization is neutral on this, but if we did see this, and it can be a little bit noisy, but if we do see this 12-month moving average really in earnest start to trend downward and this gray line continue to remain under that 12-month moving average, that would confirm this as another potential late cycle indicator. I mean, again, this is just another data point to be taken into the context of all the other data that we're looking at. Here is the checklist for November 2018. So still mostly positive across the board. We've got some negative outlooks on these longer term indicators, and then this U.S. building permits, which is a medium to longer term indicator. I'm calling that neutral right now, but as I said, if the data continues to come in and suggest that we are seeing a topping process here and this really in earnest starts to trend lower, I would downgrade that to a negative outlook for that line item on the checklist. Then you can find the PDF online and read the conclusions and thoughts here. Data developments have generally been mixed between over the past month since last month's report, but overall the expansion does look set to continue for the next few months and in general until further notice. All right, let me leave it there.